risks are to be avoided, generally speaking, such as reckless driving or cheating during exams. But when we are talking about making our money work hard for us, risk is not about mitigating, but managing. Risk and reward are two sides of the same coin. You see, without taking any risk, you cannot expect to have any return. However, what you can do is understand and control the form and level of risk in such a way that you get more bang for your bucks. Hi guys, I hope you're all doing well. So I started my finance career specializing in investment risk across different asset classes from equities, bonds to private market. So in this video, I really hope that I can give you a good flavor as to different types of investment risks that are out there that I tend to look out for on behalf of my own client so that you can also do the same with your own investment portfolio. So investment risk can be categorized in two main ways. You have the systematic or the market risk, or you have the unsystematic or the idiosyncratic risk. Market risk is something that you will always have. You cannot ever completely eliminate it because you are invested in the market. But when it comes to idiosyncratic risk, which is quite unique to your own portfolio, it is something that you can eliminate or diversify away. So if you think of your overall total level of risk in your portfolio as this line here, so this is the amount of total risk that you have, and on the x-axis, you have the number of investments in your portfolio. What you will notice is that as you increase the amount of investments in your portfolio, your total level of risk comes down. But it does not quite ever get to zero because this is the amount of risk that you cannot diversify away. This is called the market risk, as I have just mentioned. However, this is the amount of risk that you can diversify away, and this is the idiosyncratic risk. And in a nutshell, this is basically the diversification benefit. So in this video, we will focus on different types of market risk because it is something that we cannot completely avoid, but something that we can definitely manage. Let's start with the beta. A beta number basically measures how sensitive your investment returns are with respect to the market. So if you think about what you were taught back in school when it comes to very simple linear regression or an equation, you know that you can write an equation by y equal to a constant or an alpha, in this case, plus you have a beta times x, right? In this example, y is your investment return and x is the return of the market. For example, in the y, this could be Tesla return, and in the x, this could be return of S&P 500. Now, when you run this equation, this beta is something that you will measure and estimate. And this number can be anything, and it will show how sensitive your returns are to the market. For example, if beta is equal to 1, it means that your investment return will co-move exactly with the market. So if the market goes up by 10%, your investments will also go up by 10%. But if your beta is above 1, say 1.1, it means that when the market goes up by 10%, your investment return will actually go up by 11%. So how you get this number? You're multiplying 10% by 1.1 equals to 11%. And by the same concept, if your beta number is around, say, 0, then it means your investment is not sensitive to the market. It is not correlated to the overall market. And if you get a beta number which is less than 0 or a negative beta, it basically means that your investments will move in the opposite direction to the market. So the way to think about beta is that if you have a number above 1, it means it is more volatile than the market. And if you have a number below 1, it means it is more defensive or less volatile than the market. These measures are not very hard to get. And if you invest in funds, for example, here I'm looking at Bailey Gifford's Positive Change Fund from Fidelity's website. I can see that they are reporting the beta number under risk and ratings category. So for this fund, the beta is 1.08 using 3 years of performance history. Now let's talk about volatility. This is commonly explained as price risk because volatility is simply movement of your asset's price. A lot of people confuse volatility as risk. It is not a risk, it is simply a measure of risk. Because remember, wild swings, they work both ways. So the daily movement in the price of your investment should not really worry you as a long-term investor. So how can we actually measure this volatility? So the volatility of a stock or a fund is simply the standard deviation of its price return. In statistics, we have a very simple way of measuring or visualizing this volatility. So if you think of, again, back to school, the normal distribution, this is the way we can represent the price return of our investments. assuming they are normally distributed. By normally distributed, I'm talking about the shape of the curve, which is known as the bell curve. The bell-shaped graph helps us to visualize how spread out our investment returns are from the mean. So if you think of the peak of the graph as the mean return of our investment, standard deviation tells us how spread out our returns are from the mean. So we can use this theory to figure out how wild our investment returns can get and how much probability we can actually assign to them. So according to this theory, our return from investments, say 6% return or 7% return that we expect to get over a year, should fall within the one standard deviation bucket 68% of times. So that's the probability assigned to this bound. So what do I mean? Let's take an example. Let's go back to Fidelity's website and pick up the volatility of that fund. So you can see that the volatility or standard deviation of the fund is 19%. So what this means is that from its mean, so the average annual return that you can expect from this fund, the expected return that you can get will vary by one standard deviation. So mean plus 19% and mean minus 19%. So let's say the mean or the average annual return of this Fidelity fund is say 5%. I'm just making this up, by the way. What this means is that with this 19% volatility, you can expect to get an investment return of 5% minus 19, which is minus 14, or 5% plus 19, which is 24. So you're bound. So the expected amount of return you can get is between minus 14 to plus 24%, 68% of the times. So that's within one standard deviation. So as you can imagine, higher the volatility or higher the standard deviation, wider your expected level of return will be. So if you are someone who wants to take a higher level of risk for higher level of return, then you would opt for funds that have a higher volatility. Compared to someone who wants to have a bit more narrower set of return, then you would focus on funds with lower level of volatility or standard deviation. Next, let's talk about concentration risk. Basically, do you have all your eggs in the same basket? Having a good level of diversification can bring down or reduce the total amount of risk in your portfolio without compromising returns. You can get diversification across different ways. For example, within assets, so stocks and bonds, or within stocks itself by diversifying your investment across geographies, sectors, market cap, and different styles of investment. To help you visualize, let me show you what I mean. If you only invest in, say, Fidelity's World Index Fund, which is all stocks, you can get an expected level of volatility of 14%. And if you only invest in a bond fund, such as iShares Overseas Corporate Bond Fund, you can have expected volatility of, say, 80%. Generally, bonds are less risky than stocks. But if you invest in a mixed allocation fund, such as 80% in equity and 20% in bond, you can hope to get a much better risk-adjusted returns or reduce your volatility. In this example, this particular fund has a standard deviation or volatility of 7%. So when you're talking about managing risk, if you want to have a little bit of extra risk for an expected higher return in your portfolio, you can start to dial up the level of equity allocation or dial up your exposure to the most risky part of the stock market in order to increase the total level of risk. But if you want to bring down the total level of risk in your investment portfolio, you can start to allocate your money towards more defensive sides of the market. So you can allocate to bonds. If not bonds, then you can allocate to other types of stock market fund where the beta is less than 1 and a much lower volatility. And you can get this number very easily online from your different provider. But the question is, why is this diversification happening? Why adding new funds in your portfolio helping you to bring down the overall level of risk in your portfolio? And why adding bond fund is likely to bring down the risk level much lower compared to adding another stock fund? Well, it's all to do with correlations. Generally, stocks and bonds go in opposite direction, unless we have a crisis period like we had with COVID when both stocks and bonds were down. And in that case, other investments such as gold and the US dollar usually work as a safe haven investment. As you can see, dollar helped to diversify when stocks sold off massively during March 2020. And investment in gold would have done the same as it outperformed the returns of S&P 500 over the last 2 years. So the key takeaway really is don't put all your money in S&P 500. Regardless of how well S&P 500 has done over the last 10 or 15 years, there is no guarantee that it will likely to repeat the same amount of performance going forward. You're much better off diversifying your investment across different geographies such as Asia, emerging market, UK or Europe, or diversifying across different market cap sizes. Since S&P 500 only holds large cap companies, you do have a risk concentration within that space. Moving on to what we call macro risk, or risk emerging from what's happening in the macroeconomic landscape. This includes things like interest rate and inflation. I have a video talking about how inflation and interest rate impact the stock market performance. You may choose to check that one out after this video. And these macro risks such as inflation and interest rate, you cannot simply avoid it. They are out there and they are going to impact your portfolio. But what you can do is hedge against them or manage your risk in certain way in order to reduce its impact. When it comes to interest rate, they tend to negatively impact stock market performance, and they tend to impact bond market performance by a much higher magnitude. Intuitively thinking, a high interest rate increases the opportunity cost for you as an investor. It basically gives you less reason to invest your money into the risky part of the market compared to putting them into a high rate savings account. When it comes to stock, a high increasing interest rate negatively impacts the true intrinsic value of the stock. Because if you think about how a stock is valued, which is, for example, according to this formula, you have the future cash flow of the stock. So how much money is this company going to return back to the business or to the investor over the next 10 or say 20 years? And in order to figure out how much this future value is actually worth in present time, we divide those future cash flows by interest rate. Here, interest rate works as a discount factor. So you're discounting future value into current terms. And as you can imagine, as interest rates go up, it brings down the overall value on this side of the equation down. It basically reduces the true intrinsic value of the stock. So by this very formula, interest rates are likely to impact some stocks more than the others. So stocks that are known as the bond proxy, so those with high dividend yield that works like bond, or stocks that are very high growth, they're likely to be more impacted by rising rates. So high growth stocks are generally more sensitive to interest rate because most of their cash flow amount that they give back to investor is further out in the years. So you're discounting a big chunk of your future investment back into present terms using a high level of interest rate. So when it comes to investment risk, you can manage the interest rate risk by having your investment across different types of funds. So making sure that your investment portfolio is not significantly exposed to only the high growth stocks. Now, when it comes to inflation, you can expect to get a similar impact as well, because inflation is generally associated with rising price. Inflation is capable of eating away the true value of your money if it is not well protected. So when inflation is high, it usually puts a lot of pressure on a company's profit margin, because in one hand, they're seeing a rising input cost, but on the other hand, the company is not able to completely pass on that rising cost to their customer by rising prices. As an investor, we should really care about the real rate of return and not the nominal rate of return. The real rate of return is equal to the nominal rate of return minus inflation. So when you look into investment returns of say S&P 500 and it quotes you say 7%, so that's your nominal return. But at the same time, you have to think of inflation, because if your cost of living is actually increasing say 2 or 3% year over year, then ultimately what comes back to you is this true return or the real return. So if inflation is 2%, that means your real return is actually 5%, the true return, and not really this 7%. So this is something to bear in mind, and it's the reason why inflation is considered to be a risk. When it comes to risk management, there is a way to sort of manage around this inflation risk. So what you can do, you can invest in stocks or companies that are able to quickly pass on the rising cost to the customer. Or if you want, you can actually invest in real assets. Real assets are types of assets that are tangible in nature and their value actually goes up with inflation. So things like properties or commodities such as gold and oil. But the one type of asset that you should avoid when it comes to inflation is fixed rate bond. Since bonds are known as fixed rate product, you know exactly how much money you can expect to get back by investing in a bond, and they will be fixed until until their lifetime. So when inflation hits, the real return you get from bond investment, there is no way to hide away from it. It will ultimately eat away from that value. Talking of bonds, a key type of risk that they all tend to have is called the credit risk. Credit risk is known as the risk that the company that you have lent your money to can no longer give you back the interest payment that they have promised that they will. It's same as saying that you bought some government bonds or lent money to the government and the government can no longer service this debt, or they can no longer make those interest payments to you because they ran out of money, or that fact that they have defaulted. So if you invest in bonds, especially in corporate bonds, so you're lending money to different corporates or companies, then you should pay close attention to the credit rating of those companies. That's one way of measuring credit risk. Corporate bond investments are generally classified as investment grade and high yield. Investment grades are better quality credit where they have credit rating above a solid B. So higher the rating, less likely the company is likely to default, and also lower the interest payment that they will make to you. Next, we have currency risk. This is especially important if you invest in non-UK fund or funds that are not denominated in GBP. A simple example would be when you invest in, say, S&P 500 index fund. You may not realize this, but you are taking risks that comes with volatility between GBP and USD. Depending on how strong the movement is, it is possible for FX to completely wipe out your investment return or even lead to a negative investment return. One way to manage this risk is by investing in GBP hedged share classes. Some fund provider will give you this option. What it means is that your investment return will not be impacted by movements in different currencies. But the downside is these share classes generally comes with higher fees compared to the non-hedged share class. Take Fidelity's US index fund as an example. These two funds are investing in exactly the same asset, but one is hedged and the other one is not. And the hedged one is charging you more than double, roughly 9 basis points more in management fee. But why might this FX move so much, and what drives the FX market volatility? Well, this brings us to the last risk type on the table, which is macro or political risk. We spoke about macro risks such as interest rate and inflation. FX is another type of macro risk which gets influenced by political environment. If a country's outlook looks negative, it makes investing in that country's asset less attractive, which ultimately reduces the demand for the country's currency. A good example is Brexit. The pound dropped about 20% after the EU referendum. So as you may appreciate that some of these political or macro risks are pretty hard to avoid because they are happening whether you like it or not. But what you can do is again minimize its impact by having a well-diversified portfolio. So when I look to stress test my client portfolio, I would run different types of scenario and see the impact it can have on the underlying investment return. For example, I will look into things like what may happen if there is a big trade war between US and China, or what can happen if we suddenly have a big uptake in nationalistic policies across the world. Well, there is so much more depth that we can take this into, but as an introductory video, I hope it gave you a good flavor as to the different types of risks that investment professional would usually look at, that you can also look at yourself in order to better manage your portfolio. Well, that's all for today, and until next time, look after yourself and your money.